Hey gang, welcome to another episode of Time in the Market. It's been a couple of months since I've done one of these, so I figure it'd be worth getting back into it. Really, there's been a lot of exciting stuff happening in the market, and I wanted to see how my portfolio has done through all these turbulent times, and you can kind of see the results here. When I did my last update, I was sitting right around 26,000, just a bit shy of that, broken out between 11K in the Aristocrats portfolio, about 14K in the Industry Bets portfolio. Now, 3 months later, I've grown that by more than $10,000. I'm sitting at 36,000. A lot of that has just been buying through the market turbulence that happened in the last couple of months. I'm a long-term investor. My channel is called Time in the Market. It's all about investing for the long term. So anytime the market drops, it's a perfect opportunity to buy more because the values are better. There's certainly a lot of uncertainty around what's going on in the world today, and whether or not the market is overpriced right now is a question that's hard to answer. On the face of it, it seems like it is. We're basically, year over year, the S&P 500 is pretty much flat or maybe even above where it was this time last year. And there's certainly a lot going wrong with the American and worldwide economy. On the other hand, there's, $3 trillion more in money being pumped into the system via various government programs that have taken the supply of money up very quickly, and have also taken the interest rates down to 0% or close to it in a lot of markets, and even negative in certain countries. So stock markets suddenly look a lot more appealing when the yield you get from other things is basically zero, right? So the valuations have gone up, even though the macroeconomic views have certainly not been favorable. There's a lot of unemployment right now. I'm very lucky to have my job and be able to continue investing, but a lot of people aren't that lucky. And this pandemic is still ongoing, right? Seems like a lot of states and countries are starting to open up a little bit, but it's far from gone. So there could be issues that, bring about some further economic issues down the road. And even the economic issues that have emerged from this, the fact that we have so much unemployment, the fact that real estate is really a big question mark right now, because so many people are working at home, so many retail stores are closed and not paying rent. And what does this mean for retail real estate? What does it mean for commercial real estate in the future? What does it mean for retail in general? A lot of companies are doing well in this environment, but a lot more companies are doing poorly. So we're going to take a look at how that's related to my portfolio. So you can kind of see the results here. $36,000. I'm very happy with where the portfolio is. More than $10,000 in growth since the last update. My forward income has jumped up by about $185. If you remember, the Aristocrats portfolio is dividend focused. The Industry Bets portfolio is more growth focused. You can kind of look at my dividends in the past couple of months too, and kind of see the growth there too. It's not a lot, $27 in January, $23 in February, but it's starting to grow. March was $45. April was $37. May is looking pretty good right now. Certainly some dividend cuts in play. Actually had one last night that is going to impact my Dividend Aristocrats portfolio. So we'll talk about that soon too. But, things are looking okay. I think the dividend picture in the near term is going to be murky. There's already been quite a bit of cuts and suspensions, even by large corporations that you would expect to be able to make it through trying times. Disney, for example, suspended their dividend. They're heavily impacted by this. Just yesterday, like I mentioned, Roast Stores, one of the Dividend Aristocrats, suspended their dividend after paying for 25 straight years, paying and raising for 25 straight years. So that means they're essentially out of the Dividend Aristocrats list, and I'm going to be selling them. That's what the portfolio is about. It's about owning Dividend Aristocrats. So I think dividends are going to be growing within this portfolio, but in general, dividends are going to be pressured. In 2008, dividends dropped by something like 25% in the S&P 500. I wouldn't be surprised if that happens this time around. There's going to be more dividend cuts. There's going to be more dividend suspensions. Increases are going to be lower than they have been in the past. And that's probably going to continue through the end of 2020 and probably well into 2021. It's going to take a while to recover from this. And right now, stock prices seem elevated, but who knows, right? Like I mentioned, there's a lot of variables going into that pricing that is difficult to judge because this is such an unknown territory. So let's look at the two portfolios that I have. First, let's start with a Dividend Aristocrats portfolio. That one's at 1790.43. So if I look at how this portfolio has done in the last year, I'm actually down a bit. You know, when I talked about the S&P 500, I think it's up something like 3 to 4% in this same time period. The Dividend Aristocrats portfolio has kind of lagged the market, and that's kind of concerning because this is the portfolio you would expect to do well in situations like this where times are tough. People kind of tend to go towards companies that are historically stalwarts during difficult times, and the Dividend Aristocrats are companies that have raised and paid their dividend for 25 years or more in a row, and that makes you think they're going to be stalwarts in times like this. The problem is that this is a scenario that people couldn't really envision, and it's impacted a lot of these companies in a big way. And what I mean by that is if you look at some of the holdings that I have in here, some of the ones that have done poorly are the ones that are kind of driven by retail or driven by gas prices, which have fallen, or have some sort of element that may be impacted by real estate or interest rates or something like that. So Raytheon is here, but that's a spin-off, so the gain here is misleading. I didn't actually pay $397 for Raytheon. I paid $397 for UTX, which then spun off into Raytheon, which Carrier and Otis. So those are also part of the positions now, whereas they weren't before. So that's why the positions went from 64 to 66, because those two spin-offs were added as well. But if you look at some of these actual stocks that have been performing poorly, you've got Cincinnati Financial Corporation, which is, I believe, a banking company, which is going to be impacted by low interest rates. You've got ExxonMobil, which is really being hit hard by the low gas prices, and gas prices have kind of recovered a bit, but they're still far off where they need to be for ExxonMobil to be doing great. Ben Franklin Resources, which is Franklin Templeton, which deals with the stock market. Again, a lot of people are moving towards the index investing part of things. Some of these companies aren't doing as well as they used to do. And it's always difficult to make really good money as a stock advisor company when the stock market is turbulent and not doing well, because a lot of people will pull out their money, a lot of people will invest in safer things, a lot of people will be less willing to pay for that type of resource when the resource doesn't seem to provide any immediate value. You've got WFC Corp, which makes clothing. You were heavily impacted by retail closures, and you kind of go on and on. You've got Realty Income Corporation in here, which is a new Dividend Aristocrat that was added this year. Again, retail is struggling. These guys are a real estate investment trust. They invest in buildings that they then rent out, and if stores are closed for an extended period of time, the rent becomes a concern. Are they going to be able to collect rent for an extended period of time? Same with Federal Realty Investment Trust and other investment trusts. You've got Aflac, which probably has insurance exposure that could be impacted by any litigation that comes from Corona and what happens when it comes to that aspect of things. So a lot of stuff going on here. A lot of companies that are just kind of struggling in this environment because they're related to real estate, or related to oil and gas, or related to retail, or related to insurance, or related to banking. And kind of those industries haven't done really well. And historically, those industries have been strong because they are able to withstand generic economic turbulence. But this is far from a generic economic time, right? The pandemic is impacting businesses that haven't normally been impacted in a big way by these types of things, and it's changing the way people are investing. I mean, there's still winners in this portfolio if you look at the other way around. Clorox is doing great. S&P Global is doing great. Lowe's, Home Improvement, etc. is doing great. Sherwin is in that realm as well. Certain health companies like AbbVie and Abbott that are involved in trying to come up with a solution or utilizing testing to deal with the pandemic are doing well. Target, Walmart, Brown-Forman, which is alcohol, larger retail corporations are doing well because companies are people are actually going out and shopping for things that they need. That's one of the only things that we can actually do outside. Go to the store, wear a mask, of course, but still go to the store. And Walmart and Target have done well through the time. There's other companies that are doing okay as well, but in general, this portfolio has lacked the S&P 500 because it lacks the one thing that's doing well, and that's doing really well, and that's technology. There aren't a lot of technology corporations in here because a lot of those haven't been around for 25 years or more to be able to pay dividends for that long a period of time. So when you go to the results here, because there's a retail side of things, those results aren't as great as you would want them to be. But I think, a lot of these corporations are going to pull through this and probably come out on the other side pretty well, meaning that they're pretty decent values here because they're lagging the market. That's not to say that every company will, and that's where Roast Stores comes into play. So Roast Stores is a retailer that obviously has been impacted just as the other retailers have been impacted. And they were part of this portfolio until today, because today I put in an order to remove them from the Dividend Aristocrats portfolio simply because they are essentially no longer a Dividend Aristocrat. Yesterday, when they announced their earnings, they also announced that they were not only not raising their dividend, but they were suspending their dividend until sometime in the future when they will reconsider it. And that means that obviously they're not a company that has paid or raised their dividend for 25 years in a row. And that means they're no longer part of these elite group of customers, of stocks rather, that have done that. And what that means is I'm selling all of my Roast Stores holdings today and buying other stocks with it, stocks that will hopefully not cut or suspend their dividend. But I think this is probably going to happen a couple more times, even when this cohort of stocks. There's already been dozens upon dozens of companies like Disney, like others that have either suspended or cut their dividend, and I think a lot more will come in the near term or even in the long term. I think there's probably more of these 65 remaining holdings that will cut their dividends or at least suspend their dividends in the near term to save cash, to kind of make it through through these trying times in a good way. And it's probably going to be some of these companies that aren't performing well. I mean, who knows what it's going to be now? At this point, I'm still buying every company with each additional purchase like I would normally. These are equally weighted as much as possible. Some of them are a bit higher than others simply because M1 Finance doesn't allow you to do just 100 divided by 65. You have to kind of make it work within whole numbers. But in general, these are almost equally weighted. But some of these companies will probably cut their dividend. And when they do, I'll have to sell them because, again, they're not part of the Dividend Aristocrat Club anymore. But that money will, again, be reinvested in other companies that will hopefully eventually do great again or are already doing well, and then continue to raise that dividend throughout the years in the future once this pandemic has passed us. So again, portfolio is not doing great so far. You can kind of see that I've continued to put money into it, but there was a dip over here as the market crashed. I kept buying more through this timeline to kind of recover some of these losses, because at a certain point this portfolio was down like 20-30%, like all of ours were, but now it's back up to almost even. And a lot of this growth is just further money coming into play. And what's nice about this portfolio is that the dividends keep coming, right? If you look at what's happened in May, on May 15th, I had 1, 2, 3, 4, 5, 6, 7, 8 payments, all above $1. So this was like $15 in payments, which can be reinvested right away. Caterpillar just paid me. I had some additional payments. So May's doing pretty well on the dividend front. And there's still probably some more payments to come from some of these stocks. And just because Ross Stores reduced their dividend doesn't mean that the portfolio is ruined or anything. It just means I'm going to sell that stock, potentially at a slight loss, write that off on my taxes, and then it reinvested into these other companies that are continuing to pay their dividends and will continue to grow their dividend in the future. So not a big deal that the portfolio is underperforming a bit. It's a bit surprising, but it's given the historical lack of volatility this portfolio tends to have. But again, this is not a historically similar recession that we're probably going into. It's driven by something that really hasn't happened before, and a lot more companies that are in this portfolio are in industries that are impacted. Now on the other side, like I mentioned, tech is doing great. My industry investments portfolio, which is heavily in tech, is just thriving. I was down a bit as the market kind of collapsed across the board, but over here I was buying a lot. So if you look at the portfolio again, I went from 14,000, 18,000 here. I was down quite a bit here, but now I'm back up quite a bit. Year over year, this portfolio is up, 18%, which is pretty good considering the S&P is up 4% in that timeline. And a lot of that has to do with the fact that I own companies in this portfolio that are growth companies that have done really well during this pandemic. And that's simply because a lot of them are related to the internet, and there is a big focus on tech plays right now because tech plays can be done anywhere. When there is a pandemic like this one where people are at home, they can still use Amazon to shop. They can still go on Facebook. They can still use Microsoft products. The cloud becomes an even bigger play. They can still use Shopify. If you look at some of my biggest returns here, Shopify-based stores rather, Amazon's up there, Shopify's up there with almost doubling in price since I bought it. Nvidia's up there because so many more people are using computers and the graphics cards. Microsoft, Apple, Alibaba, PayPal, Mercado Libre, which is a Latin American Amazon-type store, JD, which is a Chinese Amazon-type store. Visa's doing great because more people are buying stuff online instead of in person. Cash is becoming less of an issue. Google is still doing pretty well. Even though ad spending is probably down quite a bit. Tesla's doing well. Even companies like Sam, Boston Beer Company, are doing well because, again, people are at home. They're still drinking. And you can kind of see that there's a lot of winners here. And if you look at the individual portfolios here, my AI, cloud, health, and tech portfolio is up over 60%. My financial technology portfolio is up over 40%. My e-commerce portfolio is just soaring. It's more than doubled almost, 126% return. Aerospace related companies aren't doing great. Again, a lot of these are tied to Boeing in a way. I don't own Boeing in the portfolio, but there's a lot of companies that are dependent on Boeing for what they do. And since the aviation industry is basically shut down or not doing well at the moment, a lot of these companies that are related to that are kind of failing. Entertainment's doing well. Sense stocks aren't doing that great. A lot of these companies have suffered as well. Again, Boston Beer Company is doing great, but some of these Altria Group, Starbucks, Constellation Group, Altria, again, I mentioned that, Philip Morris are kind of struggling. So it's a small portion of the portfolio, but it's weighing down on that. And then autonomous vehicles and pets and animals are doing pretty well. So overall, the industry investments portfolio has been a great success. I've been putting more money into there. It's if you just look at the portfolio itself, if I share the pie, this is a time-weighted return. And if I look at the portfolio itself, we're essentially looking at a 32% return in the last year. That's pretty damn good if you compare it against what we're seeing in the market. The S&P 500 is only up a couple percent. This is up 30%. And again, that's obvious. The NASDAQ is doing much better than the S&P 500, and this is more correlated to the NASDAQ. But it's good to see that there's pockets of good performance in a market like this, right? Obviously, the stocks I mentioned in the Aristocrats portfolio are struggling a little bit, but these tech-based stocks and some of these other stocks that are in here are doing really well, and that's great to see. And it's great to see that kind of push the portfolio performance forward. So even though I'm down on the Dividend Aristocrats, these guys are up quite a bit, and they're kind of making the overall portfolio do well, quite well actually. Since it's a 50-50 split, I'm probably at a 12 to 13% return against the market running at a 3 to 4% return right now. And again, this could change quickly. These tech stocks are really where the money's flowing. So these returns are supercharged because there aren't a lot of investments that out there beyond stocks, and people are just kind of piling into these stocks. Could it all kind of come crashing down again like it did in March? Yeah. I think I'm going to do more of these updates more frequently just because I want to kind of track how this market is progressing. Obviously, tech is winning right now. Retail, anything related to retail real estate, commercial real estate is kind of struggling. So these are the two different parts of the pie that I'm working with. My Dividend Aristocrats are struggling, even though they normally don't in times like this, which is a flip. And then these tech stocks are doing great, even though they normally don't in times like this, which is a flip there too. So whether that continues or not, it's a question mark, but I'm continuing to buy both, right? I feel like I'm getting a good long-term deal on the Dividend Aristocrats because they're underperforming right now. And while a few of those companies will probably cut their dividends and be removed from their portfolio, most of them will kind of get through this strong and continue raising those dividends, and I'm buying them at a fair price right now. These tech companies seem a bit overpriced, but again, tech is the future. It has been for a while, and it's kind of, this pandemic has kind of forced that to the forefront and made it come faster. Retail, everybody's been saying, hey, retail has been dying, it's going to be dead in the next 10 years. Well, retail might die a lot faster now because this thing has pushed all that forward, and a lot more people are moving their shopping online, and they just may never come back. Same with commercial real estate. A lot more people are moving into the work at home environment, and some of them just may never come back, right? And that's going to benefit the tech stocks. So you may think on paper they're overpriced right now, but if a lot of that consumption shifts online, these tech stocks are going to benefit, and these other stocks are going to kind of flounder. And some of those stocks are going to do poorly, and some of these stocks are going to do fantastic, and that's already showing out in the returns right now. Whether that continues or whether things normalize back is the question, right? And that's why investing continually is important. Things that are hot now may be crappy later. Things that are crappy now may be hot later. People are kind of super down on commercial and retail real estate right now. Maybe they're right, maybe they're wrong. These could be some great deals that you're having in retail and real estate right now. Maybe those deals are never going to be that great. Maybe it's a value trap, but I think the Dividend Aristocrats portfolio has enough non-retail to kind of weather that storm. And if retail ends up dying, I'll just kind of slowly sell those stocks as dividends get cut or suspended and reinvest them into other areas. Whereas on the industry investment side, I'm not really focused on dividends. I'm focused on growth, and I always have an eye out for companies that I can add to this. So right now, this portfolio is doing well. I'm very happy with how it's doing. A 2% return over the last year is fantastic, and I'm really hoping to put a lot more money into both these portfolios and see it grow. So right now I'm sitting at 36K. The market's been fairly good the last couple of weeks. After kind of some turbulent times in March, it's recovered pretty quickly. I think there's more turbulence ahead, but who knows? I think I'll come back to doing these updates more regularly again. Again, if you like the videos, subscribe, hit the like button, as they say, and I'll be back with another update probably in a week or two. I'll try to do these bi-weekly, I think, just to talk about my portfolio, see how they're doing. I think it's going to be a good time capsule to see how things developed during these pandemic times. I want to see how my portfolio progresses. I kind of missed doing the updates in the March and April timeframe just because I was busy with work and a lot of stuff going on around my job. Now things are kind of normalized there. I'm lucky to have that job again. I'm hoping to keep that and keep investing and keep growing that forward income and keep growing the portfolio. So hopefully you guys enjoyed the video. Hopefully you guys enjoyed the update. Let me know what you guys think about the market, whether you're still investing or you're kind of waiting to see what happens. I certainly have more cash on the side than I used to have. I luckily, in my other account, I made some sales right before everything crashed, so I had some cash on the side to keep buying as things were crashing, so that worked out well. And you can kind of see it as the numbers grew here. Not all of this is growth. A lot of this is just additional money flowing into the market because I was able to sell early and kind of keep reinvesting as the market fell. And it's still down from its all-time highs. So these values are still not back to all-time highs. We're still, in certain areas we're there. Tech's certainly back to all-time highs in a lot of stocks, but a lot of companies are still 10, 20, 30% below their all-time highs. And these are good companies, good long-term companies. I think some of these good long-term companies are going to struggle with this. Some of the companies that have paid their dividends for 50 years in a row are probably going to have to really think about cutting those dividends in the next 6 to 18 months. And Ross Stores probably isn't the first one that gets removed from my Aristocrats portfolio. But, this is an interesting time, and we'll see how it all goes. So thanks for watching, guys. And I'll see you another day for another episode of Time in the Market.